Take a listen to Tom Lee and what he said on CNBC last night. This headliner is headlined, "We're at a point where the Fed could engineer a soft landing." Now, Tom Lee also goes on to say that he thinks most of the correction is likely already over with.
Just to our talk of the tape, the road ahead for stocks definitely gotten bumpier. The question now is, are there too many potholes to get around? Let's ask Tom Lee. He's managing partner, head of research at Fundstrat, also a CNBC contributor, and also here live at Post 9. Welcome back.
Great to see you, Scott.
What's going on here, Tom?
Well, it's been a rough week. I mean, this September, first 4 days were down 4%. It's actually one of the fifth worst September since 1928, so it's pretty bad. I don't think there's actually a lot of fundamental arguments for why stocks are down this much, but I think we've pulled forward to seasonality. This September to November period last year was really tough. Historically, it's tough, and I wonder if markets are going risk off early.
So you believe in the soft landing story. You said there's no fundamental reason for this. This is a debate over soft landing versus something worse. Market seems to be tilting towards something worse. You say no.
Yeah, the reason I don't think it's something worse, and we don't know, is that the jobs added was better than July. Remember, July was the hard landing fears because it was such a weak number. And in fact, the number of industries adding jobs jumped to 53%. That's the best in 6 months. And the unemployment rate fell. So I think we're at a point where the Fed could engineer a soft landing. And that's why 2 weeks from now it's going to be important.
50, 25, does it matter to you?
I think it's going to be how the market interprets either number, because there can be such thing as a dovish 50 or a hawkish 50 or a panicked 50, even a hawkish 25. So I think the reality is the Fed is on a cutting cycle. That's really a good catalyst for rotation. Interest rates are going to fall, and it's going to help industries like housing, autos, credit cards come out of this recession. So I think it's good news when they start cutting.
Okay. What's happening in tech? We said that the NASDAQ's down more than 5% this week. We're having the worst week in about 18 months, and the tech sector itself is off more than 7 on the week. What's going on with that trade?
Tech, I think, revealed its hand last week because NVIDIA had a good number, but it fell. So when stocks fall on good news, it's either a crowded trade or something bad could be coming. And then, of course, they led the downside this week. I think it is part of this pull forward the seasonality because people want to de-risk, and tech is a big holding. But I think on the margin there could also be a political aspect to this. Trump's probability of winning actually increased this week in the betting markets and in the polls. And I know investors think he'll be tough on China, which would be bad for semis. So I think part of this could be fears that a Trump gaining is bad for semis.
What if there's just too much priced into these stocks at this point? Valuations have gotten a little too rich, even if they're the greatest stocks in the world, which you've made the argument that in fact they are, that this is the place you want to be, maybe more than any other. And what if that's true and the multiples still don't make sense?
I think it's possible. In NVIDIA's last 10 years of history, there have been 30% drawdowns, almost 8 times of similar magnitude. Its PE, NVIDIA's forward PE, was actually higher at the bottom of those drawdowns. Right now, NVIDIA's forward PE is in the mid-20s. So to me, this looks like a normal profit taking. Maybe it takes NVIDIA down to the 90s, but I think 2 years from now, that's really going to be a gift.
So when you look at all of these, are you a buyer on the dip? Are you urging people who read your research and listen to you here and elsewhere to do that?
We're close to that point because let's say we thought that there would be a 7 to 10%, the risk of a 7 to 10% drawdown between now and November. We're almost down 5% now. I think next week we could be within that point of where we pulled forward that entire correction into the month of September. So I think we're close to the point where, I wouldn't be a seller here, and I think the lower range of the S&P's 5,400, 5,350, we're almost there now.
You think the move from August 5th to, let's say, September 5th was justified? Was it too much? Was it built on reality? What do you think?
It's hard to know. I know that there was panic that caused that 3-day drawdown, and the VIX spiked to 66, so we know that there was panic. But we also know there was a ton of cash on the sidelines already into August that was put to work. And I think part of this was a liquidity move because we know the yen was highly correlated with that move. And it's kind of happening again. The yen's turned strong and it's been putting pressure on stocks.
Now, at this point, if you want my honest opinion, I don't think the Fed is going to engineer anything. Not at this point. It's almost like poker, right? We've already been dealt our cards. Because even if the Fed wanted to start cutting, and they're going to start cutting, that's a certainty, September 18th, there has either already been too much damage done, and we're just now, going to start getting data that comes in bad, or we're going to have a soft landing regardless. Because here's the fact of the matter. A 25 basis point cut isn't going to do anything. 50 basis points, 75 basis points. You really have to get like 200 basis points of cuts, digested into this economy before I think you really start to boost any kind of additional investment, before you start, boosting mortgage demand, for example. Like, are we really going to declare a soft landing with the first cut? The second cut, the third or the fourth cut in the books? No, I don't think that makes a lot of sense. I think logically, we probably have to get back to neutral before we declare any kind of soft landing. And that's around 3% on the federal funds rate. We're at 5.25% today. We need 225 basis points of cuts before we can even come close to declaring whether or not we have actually achieved a soft landing or not. So on the whole soft landing, hard landing, recession, no recession topic, that is not going away anytime soon. Like, we could, if the economy does not rapidly deteriorate and the Fed does not start, cutting rates at a faster clip, like Fed Waller said on Friday, start front loading rate cuts, we could still be talking about soft or hard landing well into 2025. But what a lot of Wall Street will not tell you, it's really not about a soft or hard landing and how equities respond to that. The ultimate destination, if you will, whether that is ultimately no recession or ultimately a recession, what matters for equities is what the trajectory of the economy looks like. So Wall Street tries to, price things in ahead of time. So back in 2022, markets were not having a good year because at one point, the markets had priced in a 100% certainty of a recession. Now, today, Wall Street is pricing in a 0% chance of a recession. That's not accurate. Right, let's all just be honest. Even if you are the most bullish investor out there, you're not going to sit here and say there's a 0% chance of a recession. And if you do, hopefully you're not managing clients' money. Okay, hopefully. I mean, even some of the most bullish investors out there, I think, would say there's a 10 or 20% chance of a recession. More logical investors would say there's probably a 50% chance of a recession or more. Historically, the odds are stacked against us. Now, if the markets are pricing in a this is not rocket science, okay? We should all be able to understand this. If the markets are pricing in a 0% chance of a recession, but the actual odds are, call it 50%, a coin toss, eventually markets have to price that in, or at least they should price in, let's say, a 50% chance of a recession. That could lead to extensive downside in markets. That's where I kind of disagree with what Tom Lee says here, where Tom Lee says we could be close to the end of a correction, this 7 to 10% correction. I don't really believe that because we're still not pricing in any chance of a recession on an equity market basis. With the market that is keenly focused on economic data, if we get economic data that starts to come in worse, that's not going to be good. We also have this mentality on Wall Street that is starting to grow that maybe you should in fact sell the first Fed cut on September 18th. Mix that with a really bad, seasonal September. That could just make things even worse. I also disagree in the sense of what Tom Lee said with the election and some of that risk being pulled forward into markets. I don't think we're pricing in any of that, election risk. It doesn't seem that way to me. I think that gets priced into markets in October. And I think that leads to more downside. Because let's be honest here, okay? Whether you want T-Man to win or you want Kamala to win, they both have bad economic policies as far as economic growth and activity in the near term. Tariffs, 10% tariffs on everything or more than that, from, certain countries. I can't make an argument that's good for economic activity in the near term, okay? Higher corporate tax rate, yeah, that's clearly not a positive for, companies, right? And earnings. Also, taxing unrealized gains or losses. I could make an argument that could lead to more risk-taking, more speculative behavior that could be good for equity markets. But does that outweigh the negatives? Probably not. So I don't think you're getting much election risk actually being priced into markets right now. You also have this dilemma where this is something that, Adam Parker with Trivariate Research, he's a CNBC contributor, goes on CNBC almost every day, has pointed out, and he's been an uber bull on AI, on markets, on, soft landing, all of this. And just recently he started to say, are earnings estimates too high for 2025? If the economy really is going to slow down, should we see earnings estimates come down to some degree? Because as you start a new year, you tend to see earnings estimates fall like 2 to 5%, and earnings estimates continue to go higher. Should you see those come down? And if we do see those come down, is that going to lead to downside? The answer is yes. But we haven't seen that yet. I think markets might start to cozy up to the idea of earnings estimates coming down. And that could be leading to some of the downside we're seeing in equity markets today. So over the near term, you have earnings estimates that are too high heading into Q3 earnings, potential for negative surprises. It's not exactly great. We have the election and that uncertainty that will get priced into markets in October. You have this mentality of sell the first Fed rate cut, which is September 18th. Mix that with seasonally September, October being bad months. I don't really have too many things to be bullish on here. Even the jobs report came in worse than expected. People say the unemployment rate fell. Yes, it fell. On the headline, it looks a lot better. It fell from 4.3% down to 4.2%, but it really fell from 4.26% to 4.22%, a marginal move down at best. We also had the headline payrolls number that came in about 20,000 lower than expected, with full-time jobs that are being hemorrhaged, that are being made up for with part-time jobs. That's not a very good backdrop for the soft landers that we have out there. And again, yes, I think we'll ultimately end up in a recession at some point, but that doesn't even matter for equities. Soft landing, hard landing, doesn't matter. The odds are, the problem is, I should say, the odds are not correctly being reflected in equities. That we should not be expecting a 0% chance of a recession. The actual odds are around 50%, probably, give or take. Right? We're in the process of pricing that in as the Fed starts to cut rates. You can also make the argument that the 2 and 10-year yield curve inversion is also now starting to materially uninvert, which when that happens, historically, you are about to go into a recession. At the bare minimum, you tend to see downside in markets. And I mean, just on Friday, when you started the day, you were actually inverted 2 basis points, and you close the day uninverted 6 basis points. That's a pretty big 1 day uninversion. 8 basis points? Yeah, that's usually not good for markets. And I think that's partially why the S&P was down 1.68% in regular trading. And after hours on Friday, the S&P was down 0.30%. Another third of 1% got taken off in after hours on Friday. So from that perspective, with so much risk still here in markets, I can't make an argument that markets are close to a bottom of this, recent rout that we have got ourselves into. In fact, when you say these things out loud, election risk, an inverted yield curve, the Fed cutting rates for the first time, a lot of Wall Street starting to say you should actually sell the first cut, including Bank of America. Earnings estimates being too high, markets really not pricing in any recession risk at this point. These are problems that I don't see, even close to priced into or accurately reflected in our markets. And that's why I just don't agree with what Tom Lee says here. Now, could Tom Lee be correct? Of course, he gets paid the big bucks and I don't. Listen to whoever you want, okay? And maybe there's a mix of I'm correct, Tom Lee's correct, there can be a mix here. But I find the argument hard to believe that we're close to a bottom here, with all of the risk that we have in equities for the next 8 weeks or so. I think once we're down 10%, 15%, then we start to talk about the correction being close to over with. But at that point, how is the economy? What does the economic data say in October? That's what is going to determine, whether or not this is just a correction or a larger crash. Now, again, I don't like big tech here. Not at all. And, no matter how things play out, I don't like big tech here. Soft landing, hard landing, don't like it. Price for perfection. If we do have a soft landing and markets, do rally higher, high-paying dividend stocks, quality value, small caps, interest rate sensitive names, those are going to be the ones that benefit. And big tech fits none of those categories. None of them. They're not value. They don't pay high dividends. They're not small caps. They're not tied to the interest rate cycle. They're not cyclicals, really. And I should have added that one in there. Cyclicals. They're not cyclicals. There's just not a lot of reasons to be bullish on big tech, in my personal opinion. So let me know what you think about this information down below in the comment section. Do you think we're close to a bottom in equities? Why do you think we're close to a bottom in equities? I struggle to find the logic that would counteract all of these other factors that we've talked about. Again, really bad seasonal activity in September, election, risk coming up where there is real economic policies that are not going to be good for markets. Like, that's an actual reason for markets to be a little on the concern side. An economy that is slowing down, the Fed cutting rates September 18th, which a lot of Wall Street's starting to say, hey, you should sell the first Fed cut, including Bank of America, one of the most respected, research teams on Wall Street. And you mix that with the markets not pricing in any chance of a recession. Like, I don't see it, but maybe I could be missing something. Maybe there is something I'm missing. I don't know. I literally can't even think of one thing that would be a positive for our markets. I guess you could say Q3 earnings coming in better than expected, but that's just not looking as likely as it was before. But that, I guess, is a possibility as well. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.